Hello there. Good evening to you. I hope you're all doing well and you're enjoying your weekends as well, and also learning very hard to sit up for your exams. Tonight, we want to look at an illustration in your handout, and I'll walk you through the illustration. Then we'll also look at other areas in whatever we're looking at in terms of unrealized profits, in terms of intra-group balances, and other things that time will permit us to do. But before that, I would like you to subscribe to the channel, hit to the subscribe button under the video you are watching if you have not subscribed yet, so that anytime I put the videos and you go on YouTube, you will see the alerts. Then you can also have a view of it so that it can help you to learn. Those, if you have your handout, you can open to page 22. Yeah, the question is on page 22, but I'll be projecting it to you on my screen so that you get to have access to the question. So we're just projecting the question. So this is the question we are going to be looking at today. And the question reads, the following information relates to Oman and Muscat, an 80% subsidiary acquired 4 years ago. And you have the balance sheet given you over there. The non-current assets has been broken down into two, intangible and tangible. You have your current assets, inventory, receivables, and cash bank. Ordinary shares, accumulated profits, totaling giving you your owner's equity. Then you have the non-current liabilities and current liabilities also forming part of your liabilities. You have your additional information to be 1. Fair value of NCI at acquisition is 25. Parent cost of investment is 175. Net asset at acquisition is 100. Net asset at the year end is 150, and recoverable amount at the year end is 230. Goodwill is calculated with the NCI at acquisition at fair value and is subject to an impairment review at the year end, and no goodwill has previously been impaired, and you are required to prepare the consolidated statement of financial position of the Oman Group. Now, there are certain key things you have to understand over here. When we talk about fair value, what does it mean? Some of you might be hearing this word for the first time. Fair value, what does it mean? The simple and short answer of fair value is the market value. So when we are talking about the fair value of something, we mean that, okay, if today you are to sell that item on the market, how much are you going to sell it for? So how much are two parties going to exchange this transaction within their knowledgeable idea that this thing that we are exchanging, we are doing it with the fair price on the market and nobody is cheating anybody. That is basically what we mean over here. And in consolidation, we have, aside the cost method of consolidating the accounts, we also have a fair value basis of consolidating the account. The simple and short explanation I can give to you is that all along, whatever you've been doing is that, okay, if they said Oman is purchasing 80% or is investing 80% in Muscat, the emphasis is on the 80%. So if we get to know the net asset of Muscat at acquisition, let's say net asset of Muscat at acquisition here is how much? 100. and this guy is purchasing 80%, then we'll say that 80 is the fair, is the cost, or 80 is the value of the business in books. So in the accounting records, the value of the 80% you are coming to invest in is 80 Ghana cedis. But how much are we giving it to you at? We gave it to him at how much? 175. So the fair value for the 80% he's purchasing is 175. So initially the focus is on this. But the 20% that is left, why is it that if you are going to do the reporting, you also add the 20% to your reporting and report it as well? Meanwhile, you did not also value the 20% at the beginning of the acquisition, so that you know that, okay, this is how much the 20% also costs. That is the problem. So now the idea is that, okay, if we value the 80% and we know that, okay, this is the cost of the 80% and we are selling it for 175, then the 20% that is there, let us also value it, because now the business is going to have a total change of ownership. It's going to have a different direction of management. So let's also value the 20% and know the value of the 20%, as if somebody also wants to buy the 20% right now. How much is the value of the 20% of market? And if we know that, we will now be in the position to report accurately, so that we know that the business has progressed or the business has digressed. That is the ideology of fair valuing the NCI at acquisition. So if you acquire the 80% and you are becoming the holding company, let's also value the NCI and know that this is how much the NCI is worth. So that anytime we are talking about goodwill, we'll not just be talking about the goodwill of the 80% you are buying, but let's know the total goodwill of the company, so that later on we test for impairment, and if there is any impairment, you write it off in the books, and then you go on and on and on and on like that. That is the basis for the NCI valuation. So you can see that whatever we are going to be doing today is going to take a different form of dimension from what we've been doing, but the principles are the same. Once you understand the principle, you'll be in the position to understand this one too as well. So once the foundation is weak, your building will be shaking. Just like the vice president, he said, when the fundamentals are weak, the exchange will expose you. So if your fundamentals are weak, the question will expose you. So without wasting much time, I'll zoom in straight to the answering of the question, so that you can understand. So you open to the question on your page, then you will definitely follow. Or you scroll back, you copy the question on my screen, and then you follow back. So let's zoom in straight to look at the question. Okay, so I'll copy this question to do it. Okay, I think I've even started it over here. So let's look at it. That is it over here. Good. So with this particular illustration, we say that a man has purchased 80% of Muscat and NCI is 20%. NCI is 20%. Now, that is what forms your group structure. So your note 1, you do your group structure. Then note 2, you look at your NCI, your net assets for the subsidiary at acquisition, and then your net assets for subsidiary at the reporting date. Now, we've been told in the question that the stated capital for Muscat at the reporting date is 50. Always bear in mind the financial statement that you'll be given is always at the end of the year, or is always at the end of the reporting date, or is at the reporting date. So the balance sheet you are seeing there is the balance sheet for the reporting date. So the ordinary shares for Muscat is 50 at the reporting date. We were not told if he has issued any shares during the year. So we assume that the stated capital at the beginning is also 50 and at the end of the year is 50. Until you are told anything otherwise, it is always the same like that. The accumulated profit or accumulated surplus for Muscat in the question is 100. So the 50 in the 100 year is equal to 150. And then you can see that they said the net asset at the year end is 150. So whether they gave you that 150 in the footnotes or not, you should be able to find it yourself because the surplus is always there for you. Now, what is missing in the question is that the acquisition surplus is no more, it has not been given. You were not given the pre-acquisition surplus. You were rather given the net asset at acquisition. So if you know that capital plus surplus is equal to net assets, and you were given the net assets, and you know your capital, the matter is that just subtract your capital from your net asset, and then you get your surplus. So therefore, our pre-acquisition surplus is 50. Is 50. So that is how you are going to get your note 2. That is the net assets for the subsidiary. Then you continue to note 3, where you look out for your goodwill. Where you look out for your goodwill. Now, in an attempt to determine your goodwill, you look for the goodwill belonging to the holding company or the parent company. And then you also look for the goodwill belonging to what? Or associating to the NCI or the non-controlling interest. So in the determination of the goodwill, the cost of investment by the parent is 175. The cost of investment by the parent is 175. That is by Oman. Oman bought the company for 175. Meanwhile, the net asset of the subsidiary at acquisition is 100, and Oman is investing in only 80%. So 80% of the 100 gives you 80 Ghana cedis. So the cost in the books, 80% cost in the books is 80 Ghana cedis. But he paid how much? 170. He paid 175. So therefore, the goodwill on acquisition is 95. Once he paid more than the value of the business, he is paying for goodwill. So the goodwill on acquisition is 95. This is what you have been doing all along. Or this is what we've been doing in our earlier discussions or in the earlier presentations. We determine the goodwill here, then we end it over here. But under the fair valuation method, you were told in the question that goodwill is calculated with the NCI at acquisition at fair value. So it is because of these statements in the footnote, we are also valuing the goodwill for NCI at acquisition. So on the date of acquisition, the 20% of the business also has been valued and came to the realization that the value of the 20% left in the book is 25. So if you are to also give the 20% to another investor right now, he will pay 25. But the value in the books is how much? It's 20 Ghana cedis. So how much will be the goodwill? 5. So we can confidently say that the gross goodwill is 100. So this one is called a gross goodwill. So the 95 plus the 5 gives you a gross goodwill of 100. So this is the second or the third, I think this is the third illustration that you do. The next thing you do is to go and do your note 4, where you test for impairment. So let's do note 4. where we test for impairment. So note 4, we are going to carry out impairment review. Now, anytime we say impairment, it is loss. Anytime we say impairment, think about loss. But loss of what? The loss in goodwill is called impairment. So the loss in value of a fixed asset is called depreciation. The loss in value of an intangible asset is called what? Amortization. The one for goodwill is called impairment. So when goodwill has suffered a loss, we say goodwill has what? Impaired. And when we are writing it off in the books, because we are what? Amortizing it in the books. So anytime this goodwill 100 here has reduced to 70, the 30 is the impairment. Take note, the 30 will be the impairment. The loss, any loss that will affect this 100 is the impairment. So you need to carry out an impairment test at the end of the year to know that this 100 that we got at the beginning of the year, at the end of the year, is it still intact? If it is intact, then we are okay. If it is not intact, then we must ask questions. And to carry out an impairment review, you need what you call the carrying amount or the carrying value of the business. When we say the carrying value, we are talking about the net book value. So how much is the book value of the business? That is what we need. And then we also need what you call the recoverable amount or the recoverable value. If today we are to salvage this business, how much can we sell the business for? It is different from when we are selling it willingly. But if today, let's say we are closing down the business, how much can we salvage the business for? Let's say this business is suffering, and we have to close it down and sell off the assets. How much can we recover? Is the recoverable amount. And so therefore, these two figures or these two analyses putting side by side is what we use to carry out the impairment test. And so therefore, if your carrying value is more than the recoverable amount, then there is a loss. Meaning the value in book is more than the value you can get outside if you have to salvage the business, then there is a problem. But if the value you get outside is more than the value in the books, then there is no problem. So first of all, you look at what you call your carrying value. And when we talk about the carrying value here, you mean the net assets at the reporting dates. The carrying value here you pick is your net assets at the reporting date, which is 150. Plus the gross goodwill. Now, there was a goodwill, so we add it to it. So therefore, if, let me put it this way. Let me put it this way so that it will make sense. So that what I get here is my carrying value. So my carrying value or my carrying amount is 250. So when I add this and this, I get 250. Now, what do I need? I need my recoverable amounts. So now the value in books is 250. Now the recoverable amount given in the question is 230. So the business can be salvaged for only 230. So what do? If the value in books is 250 and the recoverable amount is 230, then there is a loss. So a loss of how much? 20. So we say impairment loss. So there is an impairment loss of 20. What this 20 means is that the goodwill you are seeing here for 100 has suffered a loss of 20. So that is what it means. Goodwill has suffered a loss of 20. So at the end of the day, what do? Anytime there is a loss, it affects your revenue or it affects your income. Anytime there is a gain, it affects your income. So once there is a loss, as a good accountant, you should know where you should be channeling into. And under consolidation, if there is a profit, it is shared in the proportion of the percentage holding, 80-20, like we are saying. And so therefore, if there is a loss, it must also be shared in the proportion of the percentage holding, 80-20. That is what it means. So when we go to our note 5, and we are going to find our accumulated group, or let me say accumulated surplus, and that is for the holding company. Under your accumulated surplus, you look out for the reporting date surplus for the Muscat, right? Who's the holding company? I think it's Oman. So Oman's reporting date surplus is 240. Then the next thing you do is that you find the share of Oman post surplus. And to get the post surplus, it is the net asset of the reporting dates, or net asset at reporting date, minus net asset at acquisition date, gives you your post acquisition surplus. Or when you look at the surpluses, the net asset here, this is what I'm saying, 150 minus 100 gives you a post acquisition surplus of 50. Or when you look at the surpluses here, it was 50 at acquisition. At the reporting, it is how much? It is 100. It means that the acquirer has added on how much? 50. So after acquisition, 50 more has been added. So you can look at it on its own merit here, or you can just pick the difference of the totals and you get the same thing. So 80% multiplied by the 50. And it will give you 80% of 50 should give you 40. Yes. So when I add the two, you'll be getting 280. You'll be getting 280. Now, all things being equal, this is how much should go into your balance sheet as a surplus for a command. Anytime there is an impairment or we are writing off goodwill from the books, you shouldn't lose the hindsight that it will be affecting this surplus over here. It will be subtracted from the surplus. If this is a T account you are opening, this 240 and the 40 will be on the credit side, and any goodwill that is being written off or any impairment will be debited to the accounts. If there is any unrealized profit, it will be debited to the account. So take note. So here we subtract any goodwill impaired or any goodwill we are writing off or unrealized profit from here. But take note, it is always in the proportion of the percentage holding. You must always take note of the percentage holding. But as a way we are going, I will explain everything bit and pieces for you to understand, and you must get the principle right. Once you get the principle right, everything is going to be okay. So now we have impairment. We have impairment to be 20. Total impairment to be 20. And a man is having 80% in the company. So anytime there's profit, you enjoy 80. So anytime there's loss, you should also enjoy 80. So 80% of the 20, suppose it should be 16, if I'm not mistaken. So therefore, the surplus at reporting date now will be 280 minus 16. 80 minus 16, 64. So 264 should be our balance. So the surplus at reporting is 264. 264. Then the next thing you look out for is your notes. 6. You are looking at your NCI. You are looking at your NCI. Your NCI. Let me just copy it so that I'll move quick. So NCI, which is known as a non-controlling interest. So now NCI is having 20%, and NCI of reporting date net assets, 20% of 150 is 30. Then you also find your goodwill. So you have goodwill of NCI, just like we added the goodwill to the holding company's own. NCI goodwill is how much? Is 5. And so therefore, total is going to be 35. But don't forget there was an impairment. And this impairment, 20% will be attributed to the NCI. So 20% of the 20, which is 4, will be attributed to the NCI. And so therefore, surplus of NCI at reporting is 30 plus 5 minus 4, 31. So NCI at reporting is 31. So this is how the workings for this particular illustration look like. And this is how you are going to go about it. Now, the next thing you have to look at is the preparation of your statement of financial position. So let's look at the preparation of the statement of financial position, and this is for Oman Group. Oman Group. Now, goodwill can be seen in note 2. But take note, the goodwill was 100 and has suffered impairment of 20. So goodwill is now 8. Goodwill is now 8. Then tangible assets in the question is 100 for Oman and then 100 for Muscat. So 100 will give you 200. So the total here will be 208, if I'm not mistaken. Then you have your current assets. You have 140. Sorry, you have current assets inventory. So you have inventory 140 and 200. So inventory is going to be 340. Then you have receivables. Receivables to be 160 and 100. So your receivables is going to be 260. You also have cash at bank. And cash at bank, you have 125 and 200. So 125 and 200 should give you 325. So total of this should be equal to 340 plus 260 plus 3256, so 925. So 925 is the answer. You have current liabilities. You have 200 plus another 200, the two of them. So you're gonna get 400. Then you have non-current liabilities, 100 and 250. So all is 350. So 400 plus 300, 350 is 750. So 925 minus 750 is going to be 175. So 175 plus 280 is going to be 55. Then you have your finance by, so I'm not doing it equity and liability, so I have only my equity. Share capital for Oman in the question is 160. Accumulated surplus. Accumulated surplus is in note 5. So note 5, which I have, I think 264. So 264. NCI is in note 6. So NCI of 31. So 160 plus 264 plus 31 is equal to 455. So this is basically what you are going to do, or what we are going to be looking at. But this is how your illustration is going to go. And that is the answer for this particular question. Now, I would like to move forward a bit, but I'll do the explanations, then I'll bring practical illustrations to explain. From here, the next principle you look at is what we call the intragroup balances. Intragroup balances. First of all, you know what is called a group. A group is a parent and all its subsidiaries. So when we say intragroup balances, we mean balances within the group. But the balances arises as a result of the transactions. So delving down from intragroup balances, I'll call it intragroup transactions. So we are going to look at intragroup transactions. Now, the law stipulates that anytime there is an intragroup transaction, you eliminate it from the group or from the consolidation process. So anytime we are consolidating the account and there are intragroup transactions or intragroup balances, they must be eliminated from the group because it is simple. The relationship here is a parent-subsidiary relationship. It's like you and your mother. Your mother is selling in the provision shop. Today you go to her, then you bought things worth 10 Ghana cedis. You pay your mother. Then tomorrow you are going to school. Then you go and stand there. Mommy, I need chop money for school. Then your mother dip hand in the cash till and gave you 10 cedi from the cash till. In a nutshell, the thing you bought yesterday, have you bought it? Because the money you have given to your mother has also given it to you. So you gave it at one end, she received at one end, she also gave to you at one end, you also receive at one end, and it is the same people. So whatever you do, it is not going to have any effect on the account because you give, she receive. It's the same account you are preparing. So debit credit, there is no effect. It's just inflating the figure or reducing the figure. But in actual fact, there is no effect of those transactions in the books. So whatever they are, we take them off. The first one we look at is current accounts. So when we talk about intragroup current transactions or current accounts, we mean the instance where the parent is owing the subsidiary. So the parent is a creditor to the subsidiary. Sorry, the subsidiary is a creditor to the parent, and the parent is a debtor to the subsidiary. Or the subsidiary is owing the parent. So therefore, the subsidiary becomes a debtor to the parent, and then the parent becomes a creditor to the subsidiary. So in one breath, somebody will be owing somebody. Now, anytime you owe somebody, and the accounting principle states that you must recognize the transactions in the book once you have entered into the transaction. So once I've made an expenses, whether I've paid for it or I've not paid for it, it must be recorded. I must recognize it. That is why we have paid and unpaid expenses and paid and unpaid liabilities in the books. That is why you can have unpaid and you have accruals and outstandings in the book. Yes, you have consumed the services, but you have not paid for it. Now, there can be an instance where you owe. So you owe me. I know you owe me. Then you're owing 100 Ghana to me, and I recognize it in my book. You are owing me 100 Ghana. The moment you paid that 100 Ghana, you will record it in your books that you have paid me. But until it has reflected at my end, or the check has cleared from my bank, I will not see it. So until that day, I'll still know that you owe me. Meanwhile, you have cleared it from your books that you did not owe me. And it happens a lot in the field of accounting. It happens a lot. You are closing your books at 31st January and 31st December. Somebody owe you. He has already paid you. He cleared it from his books that he has paid you. But that 31st he has paid you, your bank has not credited your account. So 1st January, the person is still owing you. 2nd January, you are calling the person, but Charlie, I have paid you already. I get you this. Sometimes you will be receiving a payment advice, but until it has cleared, you will not clear it from your books. That is what it means. So it can happen that the parent has sent a money to the subsidiary, and the subsidiary has not received it. So you see it in the parent books that the parent is owing the subsidiary 40. Meanwhile, the subsidiary is still maintaining in his books, and the subsidiary is owing him 100. Now there is a difference of 60. That difference of 60 is what we'll be working on, and it is called in consolidation cash in transit. Once the payment has been made and it is yet to be received by the intended recipient, and the recipient is still maintaining the original outstanding in the books, that difference is called cash in transit. So for example, if Muscat owes Oman 100, and Muscat paid 40 out of the 100, Muscat will be recording in his liability side that he is owing Oman 60. But Oman will be still recording at its current asset side that Muscat owes him 100. Now, what we'll do is that when we are consolidating the account, we will eliminate 100 from this account because he is still maintaining the debtors 100 in the account. We will eliminate it from this account. We will also come and eliminate 60 from this account. Then here, we'll bring in an account called cash in transit, 40. So we'll record it over here as cash in transit. So anytime you see cash in transit, it means that the money has been paid, but it is yet to be received. That is what it means. That is number one. We have intragroup dividends and then intragroup interest. Now, let me take it from dividend. Because the accounting principles we are using is the accrual method and not cash accounting. Once you have not received the money and you know about it, and you know and you are certain, you can include it in the books. Once you are not certain about it, you cannot include it in the books. And it happens to dividends, ordinary share dividends. You don't know how much you are entitled to until it has been declared. If it has not been declared, you don't know how much you are entitled to. So until you have seen proposed dividend in the account, you don't know how much you are entitled to. So there can be an instance where the subsidiary has declared a dividend, but the holding company is not in the know or is not aware. Until the holding company has seen the subsidiaries books, then he can now include it in his books. And whenever there is a dividend declared without the holding company knowing, we also do the treatment in a way. Once you have not included it in the books, it means that there is an error. There is an error of omission. It should have been included in the books. It has not been included. It should have been a receivable. It has not been included. So it means that your receivable has been affected. Your surplus too has been affected. So in an attempt to correct that error, you adjust your receivable, you adjust the error. Don't worry, we'll come and do a practical example, but I'm just trying to explain all what is on page 27 all the way to since page 35 for you. And we'll pick an example that you understand. So once there's an error, you correct the error by stating it in the books. Once you have stated it in the books, then another matter has come up, intra-group balance or intra-group transaction. Is the money coming from the subsidiary? Yes. Who is taking it? Is the holding company. It is within the group. It must be eliminated. So we also eliminate it when we are doing the consolidation. When you get there, you understand. Then when we come to intra-group interest, as for interest, you know how much you're entitled to at the end of the year. So when you buy the debenture, you know debentures are paid every semi-annual. So if you have a 10% debenture stock, you know that every 6 months you get this, every 6 months you get that. There can be an instances where they pay you the first 6 months, the second 6 months is yet to be paid. But because you know how much you'll be getting, you can comfortably include it in the books. So most of the times the interests are always included in the books. What we do to them is to eliminate them in the consolidation process. So when you see interest, know that something must be done to it as well. Then the final thing I would like to explain is the unrealized profits. Unrealized profits. So, yes, unrealized profits. Now, what causes or what brings about unrealized profits and the provision for unrealized profits is sale of goods. Is sale of goods. Now, let me emphasize it clear here that if your markup and your margin is weak, you have to go and sharpen it. If you cannot identify a markup from a margin, then you'll be having serious problems. If you cannot identify that the figure I'm seeing here is a cost price and the percentage they are giving me here is a margin, and so therefore I have to convert the margin into markup before I can rhyme it, you have a problem. If you cannot access to know that the figure I'm seeing here is a selling price and whatever I've been given is a markup, and so therefore I need to convert markup to margin and use, there's a problem. If you cannot identify that this is what I've been given is a selling price and I've been given a margin, and so therefore I don't need to convert, I just need to use it straight, you have a problem. So if your margin and your markup is weak, then you have to revisit it and revisit it very well so that you can understand it. And I think there is a typical example on page 33 and page 34. So you can sharpen your skills over there by understanding it. But fast forward. In the group, the parent can sell to the subsidiary can sell to the parent. So you must take note. Whenever we are talking about sale of goods here, what you must take note of is who is selling to who. If you fail to understand who is selling, then the process of allocating the unrealized profits also becomes a problem. Now, let me make it simple and clear. If it is the parent that is selling to the subsidiary, or it is the parent that has sold to the subsidiary, then whatever unrealized profits you have determined, all should be charged to this particular account. This account. If it is the parent that is selling to the subsidiary, whatever unrealized profit that has arisen, charge everything to the accumulated surplus account over here. If it is the subsidiary that is selling to the holding company, then take note that the subsidiary's percentage has been shared into holding and non-controlling interest. And so therefore, if there is profit, they share it like that. If there is loss, they share it like that. If there is any profit that is yet to be realized, they must also share it like that. So if it is the subsidiary that is selling to the holding company, whatever unrealized profit you have gotten must be shared in the ratio 80-20, like this, as we are seeing over here. So it must be shared in that ratio to the holding and the subsidiary and the non-controlling interest. And it will also affect these two accounts over here. So these two major accounts you are seeing over here, ejuma wo pa. There is a lot of principles that applies to them. The principle of intragroup balances ranging from intragroup dividend, intragroup interest, unrealized profits, goodwill, amortization. You have to know that these two accounts, ejuma wo pa. So if you fail to understand these principles, you will always get these two accounts very wrong. So in the meantime, I've hammered on the explanation of this one. You can be going through whilst I make the next video, and then I'll also post it for you on YouTube to get more understanding on it. Make sure you get the compiled past questions so that when we start solving them, you'll be following, because when it gets there, I cannot be snapping every page of the past question and putting on the YouTube. Trust me, it will take a lot of data from you. So please and please again, kindly hit the subscribe button and subscribe to the YouTube channel so that anytime I post a video, you have access to it and you also learn from it, because in this corporate era, the only key is to do online and to learn online. So when you are sitting, that you learn it in the lecture hall, please, the speed in the lecture hall, you can't follow. So whether you are in the trotro, the time you waste in listening to certain things, listen to it and learn something, so that by the time you get to the lecture hall, at least you have understood something small, so that whatever the lecturer is going to add to it will be an additional, or it will be a plus to you. You will be in a better position to understand whatever I am unable here to explain for you in the lecture hall. But don't think you have listened to this and then you go and sit down in the lecture hall and be lackadaisical. Please go to the lectures and listen to what your lecturers are telling you. When you go and whatever they told you is different from whatever I have also given you here, we are all learning. Come back and come and tell me that, oh, this and this and this and that. You have to revise this or update this, and then we all do our update. But don't take it that whatever I've given you is 100%. So you are going to be lackadaisical. You listen to them. Day in, day out, updates are coming. Are you getting it? So please and please and please again, kindly do the necessary things and it will all help us. I wish you all the best and keep following Benport Consult and keep spreading the good news of Benport Consult, and we all shall succeed. Bye bye.